Okay, I think we're on. Are we live? I think we are. Are we good here? All right. We are live now. What's going on, everybody? This is Carlos, CEO of G.A.R Capital. Welcome aboard to our long-term investment seminar. We're taking your questions tonight, talking about your money, your investments, long-term into stocks and anything else you want to talk about, mutual funds, ETFs. If you want to talk about some commodities, bonds, or just cash, right? Personal finance, that good stuff, the fun stuff. We're here for you, here to help. And thanks again for joining me. So if you have any questions, guys, I have the chat right there, the left monitor of mine. So feel free to type away on the chat, and I'll be more than happy to answer your questions. We'll do this for about 30 to 45 minutes. Don't want to bore you guys to death. As long as you got those questions coming, we'll go ahead and answer them as we go. So let's rock. Okay, so let's just a couple of ground rules. No questions regarding day trading. Forget day trading, no options in this webinar. It's all going to be long-term investing, just long-term investing. So if you have a stock you want me to analyze with you, go ahead. Just keep in mind that anything you say in regards to your own money you may want to keep private. You can go ahead and shoot us a DM on at G.A.R Capital for a little more of a specific question. But if you have more of a wider approach into a question about just more of a, I guess you'd say more of a wide-based answer you need in regards to a stock, but not in particular to your money, and you don't want your information out there about your net worth and what have you, that's fine. That's totally understandable. Privacy is important. So again, just understand that any question you have will show up on the YouTube channel. So just keep that in mind. All right, there's the ground rules. All right, guys, let's go ahead and rock. A couple of things I'm going to go over. We're going to go over the investment calculator. We're going to go over some nice tools that I use, dollar cost averaging, some investments, websites I use, research, and everything else. All right, so let's go ahead. And again, if you have any questions, feel free to type on the chat here. I have it next to me. I will answer them as I go. So we are live now. Welcome aboard. All right, Brandon Smith says, you guys are awesome. I love being part of the group. Your expertise has been helpful over the past few months. Hey, Brandon, you're very welcome. Thanks so much. Thanks so much. Okay, so it's kind of, okay, so let me answer just one quick question. Let's go ahead and get this out of the way. The one question I always get is, Carlos, what do I invest in? What should I invest in, right? That's kind of probably the biggest number one question I get. I have X amount of dollars, what should I invest in? So the first thing I say is, how much are you looking to invest? That's the number one. If your answer is less than $25,000, you should be putting it into what I'm looking at the screen, Spider S&P 500 ETF. This is commission free. I'm using TD Ameritrade. This is my broker. So again, you don't have to use them. I like them, but I don't get paid to endorse them. No, I don't get referral fees from them, guys. I get nothing from TD Ameritrade. Again, you feel free to use Robinhood, E-Trade, whatever you want, Ally Bank or your bank, whatever you prefer, whatever makes life easier for you guys. So anything less than $25,000 in your account, whether it's retirement, whether it's a trading account or investment account, whatever, forget trading, investment account, whether you're saving for a wedding or your kids, one of those kind of buckets of money, just put in the S&P 500 ETF. ETF is exchange traded fund. This is an ETF, the Spider ETF. It's the most traded ETF on planet Earth, and you could see why. Again, it tracks the S&P 500. This is tracking the 500 biggest companies in the United States. So betting on this or investing in this is betting on America. So keep that in mind. So again, you're probably looking at here, okay, so what are a couple of things I look at first? So anything under 25,000 should be the S&P 500. Anything above that, then you start to want to look at individual stocks. Just keep that in mind. So S&P 500, first 25,000. Good, let's get that down. So a couple of things here. Let's look at the yield. I always like dividends. I'm a dividend guy. 1.71% dividend yield. That's great. You could see the chart has been great, and it tracks exactly to the S&P, to the T. So now you know. And what does it hold? So let's go over first some returns. Keep in mind that past performance does not indicate future returns. So you have 1 month, 3 month, 6 month, 1 year to date. Again, anything you're looking long term at least should be 5 to 10 years. So I want to look at this number here: market return, 10-year return, 10-year return. Again, you could see these numbers, double digits every single 5 years and 10 years. 31% was in 1 year. Again, that's pretty much an outlier. We are in a bull market, but 10 years, about 13% seems about right. And you can standardize returns to 13%, pretty great. And then also the thing you want to look at in a prospectus. Prospectus is basically the information that you get when you invest in an ETF, because it tells you what's holding, what's the breakdown in the sectors, what do they invest in. So the top 10 holdings in the S&P 500 is as follows: Apple, Microsoft, Amazon, Facebook, Berkshire Hathaway, JP Morgan Chase, Alphabet, both classes, Class A and Class C, Johnson & Johnson, and Visa. Again, these are companies that you know are not going to go away. Again, they're not going to go bankrupt tomorrow. This isn't a penny stock flyer. These are the bedrock of companies in the United States. Most of it is tech. We understand that. But again, tech can't fight it. 20% of the S&P fund is tech. But you see, you have some utilities, you have some healthcare, you have some financial services, communication services, energy, industrials. You got it all in there. Some real estate too, consumer cyclical, and basic materials. So you're all there. And what's great here is that there's not much of a management fee. You're not paying a mutual fund manager to own this ETF. Remember, if you have a mutual fund manager, you have to pay them 1.5%. So you have to make up that 1.5% before you make some money, because they get paid whether you make money or not. So again, that's where we are in regards to the S&P. So again, that's the number one question I always get. So I just wanted to go over that with you guys. So again, this is a pure 100% stock ETF. That's the one I recommend. If you have less than 25,000 and you want to invest long term, stick to the S&P 500 fund. Just keep that in mind. All right, question here, Brandon. My plan is to keep trading options to generate cash flow and use a portion of that each week to buy dividend stocks for long-term hold and passive income. What dividend stocks do you recommend? All right, great. So let's go ahead and kind of break that down. Dividend stocks, love them. Love dividend stocks. There's a couple of different websites you can use. I'll go ahead and give you one. There's one called Dividend Channel. There's also top 25 ranked increasing dividends for decades. But we'll just go to Dividend Channel. It's a great website to get started. And they give you rankings of their best dividend stocks over the long term. Again, you have all these up here, top 5, top yielding. But again, if you want my opinion on these, let's go ahead with number 1 is AT&T, because I love the yield. AT&T yield is right now, dividend is at 5.53%. Again, when it comes to growth for 1 year, you could see it outpaced the S&P in 1 year, but in 3 years, it has underperformed the S&P. So not a huge deal, but again, when it comes to dividends, you're looking for dividend return. Dividend, high yield dividends don't pay a lot of growth because they're not reinvesting that money. They're giving that cash to you, the investor, and they do tend to buy back stock. So again, I like AT&T. Relatively safe. It's more like a utility. We know it's a communications company, but that's where we are. Verizon is my second. It's actually my largest holding of stock. And you could see in 3 years, yes, it has been outpaced by the S&P, but has returned about 20%. In 1 year, it has returned about 10%, and the S&P has returned nearly 24%. So not exactly pacing the S&P, but again, a 4.22% yield, relatively safe. Again, 5G play. Again, long term, they pay it out, and you know what you're going to get with Verizon. You're not going to get crazy swings. Next one I like, of course, is Coca-Cola. Again, Coca-Cola's not going to go anywhere. Been around forever. We consider that a consumer staple, meaning that no matter what in a recession, people are always going to buy soda, buy Coca-Cola, right? Dividend is 2.72%. Compare that to a CD that you get in a bank, not much. And you can see there's still relatively decent growth in about a year, about 20% return. So again, you're getting a blend of return and dividend. So it's kind of hard. Think of as a seesaw that you have both. You have dividend and you have growth. If you want a higher growth company, let's just say like a Tesla like we just had, 80% return in 3 months, you're not going to get a dividend because they're reinvesting in their company. But if you have a company that has a dividend, especially a higher one with consistent returns and consistent dividend growth, then you could see that that growth is going to kind of stutter. So what your goal is to find that little bit of a balance. What is what you're looking for, meaning dividend, stick to that, but don't expect insane growth. You're not going to get 90% returns in 3 months on a Coca-Cola. You're probably going to get in 3 months about 6-7%, if that, and in a year maybe 12 to 13%, 8 to 13%. So be conservative in your approach when it comes to looking at dividend stocks. So 3, I would say Coca-Cola. I would say AT&T and Verizon. And again, if you have something in mind like a dividend name, something I own, which is an ETF, it's SPY-D, which is the SPY S&P 500 dividend yield, the dividend ETF, just like the SPY. Trades right now about 39.51 a share. It was up 2% today. Obviously, with the markets hitting new all-time highs, almost new all-time highs. The yield is right now around 4.51%, which is very, very strong. And you're getting a mixture. You're also getting some growth, but you're getting a blend of other companies that give great dividends. Nordstrom, Newell, AbbVie, Western Union, Campbell Soup, Seagate Technology, Kellogg. So you can see kind of the mixture there, right? Real estate, consumer defensive, which is like packaged goods, utilities, big one, real estate, financial services that always give back money to the investors, and consumer cyclical. So you can see here on the 10-year returns on this, again, it's only been around for about 3 years, about 9%, 3 years. If you want to look at 1 year, about 21%, which is pretty solid. Don't expect 21% return on a dividend stock, but again, this trades very close to the S&P, so you can see why. But if you want to go ahead and take a look at 4 dividend stocks, we SPYD, AT&T, Verizon, and Coca-Cola. Those are my 4. All right, so let's go ahead. And Manju Oja asks, do you think Coca-Cola is trading at a premium price right now? Absolutely. I think Coca-Cola is trading at a premium price, but they had a strong earnings report. So again, they did beat on top and bottom line. So again, if you want to take a look at what is expensive, look at the PE ratio, which is the price to earnings. It's trading at 28 times. If we compare that to the market, very simple. We can just type in S&P 500 PE ratio. And of course, I spelled it wrong. You go to multiple, you click on the first link, and you could see right now about 25 times. That's the current PE ratio. And then if you compare that to Coca-Cola right now, around 28, it's pretty much almost at a market multiple. So it's still pretty solid, not too expensive, but again, it's pretty much within the mean. So I think Coca-Cola is a great company to buy long term. Lena asks, what's the best buy the fucking dip stock in 60 days? I like my current portfolio, great gains, but I'm looking to add to my existing portfolio positions, such as Disney, Apple, and Baba. So 60 days to me is still considered a trade. So Lena, I know you're part of the investment club. So again, I show you all of my stocks that I own currently. So if you're talking about a stock that we're probably thinking about 60 days and you want to keep adding and adding for growth, again, you want to look at certain sectors that have grown substantially. Again, tech companies have been just the ones that have been on fire. So again, I don't have to go with Apple. Apple has been absolutely on fire. Their PE ratio is around 24 times. Again, compared to the S&P, right around 25. So it's right at a market multiple with the gains they have. Low dividend, obviously around 1%. But again, EPS growth is excellent. Cash position is excellent. They're pretty much an ATM machine when it comes to cash. And they can handle anything. So I would say Apple probably your best bet. Microsoft would be number 2. If you want to type in Microsoft, I still think the growth is there. We hit new 52-week highs. But again, a little more expensive than an Apple. PE ratio is around 32%, 32 times, and a 1.13 dividend. So again, you're getting a higher dividend from Microsoft. I would say Microsoft is a little safer than Apple, less volatility. But Apple, you get a little more growth than you would on a Microsoft. So again, like the seesaw, it really depends on what you're looking for. It's all about balance. It's hard to find safety and growth. That's where the key is. That's where all the holy grail of investors. Next one, Andres. I have Team Coca-Cola. I like them also. Excellent. Lena says the same thing. What is your reasoning behind dividend stocks versus growth? Well, dividend stocks to me is more cash flow. Again, it's safer in a sense. We say safer. So you want to have a balance. So good rule of thumb here is that your age. Take your age 100 minus your age, and the difference should be how much you're invested in stocks, and the rest should be in bonds or dividend stocks. Those are kind of the ways you go. So if you're 30 years old, you can invest 70% of your portfolio in aggressive growth or stocks. And then 30% would probably be in bonds, commodities, like a little bit of a hedge, a little more safer way, maybe some utilities and dividends. Again, like we talked about the seesaw. Dividends, again, you're not going to get tons of growth, but again, high growth, you're not going to get a lot of dividends. So it's all about the seesaw. I like wealth preservation. I'm still relatively young, but again, I tend to be a little conservative. I think the bull market has been extremely extended. But again, I still have some growth in my portfolio. So I don't mind giving away a little bit of growth for some protection. All right, so that's Logan's question. Excuse me. Sorry, Logan. Vanessa asks here, would you still recommend 25,000 in S&P 500 right now? Or would it be better to sit on the cash and wait for a strong pullback? No, I would suggest to get your 25,000. And a couple things I want you to look at, guys, which is very, very important. is the fact that, again, you have to look at your goals. So let's kind of break down exactly your goals. When you say you have 25,000, again, 25,000 for what? What are we looking for with this money? What's our target long term? Is this for a wedding? Is this for your kids' kids' college? Is this your retirement money? Is this just money for you to have and grow and preserve with? Again, retirement money belongs in a 401k or tax deferred program like a 401k, IRA, or Roth IRA. A Roth IRA goes tax free, but again, you have to be in a certain income bracket to do so. So let's go ahead and pretend that you just have 25,000. First thing I want to look at: do you have an emergency fund? Do you have 3 to 6 months of expenses covered if you lose your job? Most people are one paycheck away from bankruptcy. We don't want that free money. So again, take your expenses every single month, multiply that by 3 or 6, depending on you. Again, that should be in a cash savings account, something for you to have access to. It's not an investment. It's just in case something happens in life. So it makes big problems seem very small. If you have a flat tire and you have run flat tires with big rims on your truck, a $200 or $300 change of a tire is not going to hurt you. But again, if you have no savings and all your money is investing, I don't want you selling stock when you don't have to. Again, only sell stock when you want, not when you have to or you need to. There's a big difference, guys. So again, you always want to have liquid savings 3 to 6 months before you even get into the world of investing, because this investment money that you're doing, which is 25,000, Vanessa, is money you're not going to touch for 5 to 10 years. So keep that in mind. This is the bucket of I'm going to pretend it doesn't exist. It's going to work for me. I'm sending my dollars out to work for me. It's my soldiers. It's pushing. It's always working for me. My soldiers that protect me, my bodyguards, they don't work for me. They're just around me constantly. That's my savings account. That's if something happens to me. Again, that's very key. The second thing is you should be completely debt-free, because if you have a credit card where you're paying $500 a month, again, that's money you can put into your savings account or into your investment account. So get away from consumer debt. If you have debt like a mortgage, that's fine. If you have student loans, I completely understand. That takes time. I don't want student loans to get in the way of your investing. But again, these are certain things I've learned from, for example, Dave Ramsey, who teaches the Total Money Makeover. Amazing guy. And he's a great financial guru in my opinion. But again, this is tried and true. Again, stay out of debt. That's how people get rich and stay rich. Stay away from the crap and look forward to investing in your future. That's the key. Once you're at that to 25,000, then I understand, Vanessa, ETF, S&P 500. Let's do the dollar cost average together. Exercise. I'm glad you asked that question. So the S&P 500, we're going to go ahead and put 25,000, right? 5 regular installments. First initial sum, let's break it down, 25,000 in 5,000. I don't want you to put just 5,000 in one lump sum. Let's break it down into every 2 weeks or every week so we can average a better price. So let's select a market scenario, variable. We don't know exactly how it's going to go. So we'll go to number 2. And again, let's see if I get this right. A lump sum investment. So, lump sum amount 25,000. So it's 5,000 installment amounts. You go to number 2. So, for example, let's say the stock price was $8. Just work with me here. You purchased 625 shares, and then it fell. Who knows what happened? China issues, more trade issues, who knows, some foreign policy issues. It goes to $6. You just bought 833 shares. Then it jumps up again, recovers to $8. Guess what? You just bought 625. Then you came back down again. Who knows, volatility. Now you bought another 833 shares. And then it bounced back again. Markets do that, roller coaster, right? And you bought another 625. So you purchased 3,541 shares at the variable price of 868686. So the lump sum investment, instead of just putting 25,000, you would have just bought 3,125 shares. But if you would have done dollar cost averaging within 5 periods, which is 5 2-week periods, 5 1-week periods, again with this volatility in the market, you would have got almost 410 more shares. Very key. And you can see the difference in the breakdown where you see one lump sum versus the dollar cost averaging. That's the best way to go. You could see dollar cost averaging in the period versus the lump sum. Again, share value comes to 28,333 versus 25,000. So you earned a little more because you want those pullbacks because they're cheaper for you. Think of pullbacks, guys, in your investment strategy as Black Friday shopping. I don't go to Best Buy when they say TVs are up 20%, come and buy now. I want discounts. Remember, don't let price get in the way of value. You know Apple is valuable, right? Doesn't matter if it's $330 a share or it's $300 a share. If you like the company, if you've done your research, and you like where they're going long term, go ahead and dollar cost average it out, and then do it that way. And trust me, you'll save money every single time. And you see the difference. Average unit price of 7 versus 8. Look at the profit difference, $3,333. Quick exercise, a lot easier that way. The website here is amp.com. Feel free to look at that. AMP dollar cost averaging. Great question. Next one, Fahim Ali. What percentage of our net worth should be in stocks, bonds, cash? Great question. Take your age again. I'll repeat it. Take your age, 100. 100 minus your age. Let's say you're 20 years old, relatively young. You have about how many years of earning power, working and building your own business or what have you. So you're 20 years old. That means you could take a lot of aggressive approach to investing, because even if you take a loss, you can make that back because time is on your side. So conservative approach, 80% of your portfolio, if you're 20 years old, should be in stocks. 20% should be in dividend stocks, bonds, and real estate, ETFs, and gold. So you can mix that 20% how you want, but 80% needs to be in stocks. So that's how you want to do it. So again, 100 minus your age equals the amount of risk in stocks you should put in, and then the rest should be in mixtures, which should be in gold or commodities, real estate investment trusts, dividend stocks, utilities, and bonds. Safer investments, if you get my drift. Oh, so finally, I did answer your question. What is my take? Lena asked, what is my take on future crypto? The only crypto I do like is Bitcoin. And again, we all know Bitcoin can be very volatile. I mean, Bitcoin was up today, what, 6%, 7%? Again, you have to have the long-term view, guys, long-term view. If you believe in Bitcoin, if you believe that this is a difference in the way of monetary policy and a way of paying for things, then again, you want to be an investor. But dollar cost average it, guys. Don't dump all your money into it. Go ahead and do every week, piece by piece. You can always do this on Coinbase or Cash App or whatever they sell Bitcoin, like a Robinhood. For example, again, let's say you want to do $100 a month on Bitcoin. Just do $25 a week. Very simple, $25 a week, or change the numbers how you want. Dollar cost average for the long term, it'll save you money every time. So every time you get on a dip and it rises again, you'll thank yourself for that. Andres asks, what do you think of Twilio as a growth stock? All right, let's look at some Twilio here. All right, so Twilio, I believe they reported earnings today, and you can see a little bit of a drop here. Negative EPS growth, it trails the S&P right here. Again, 20% versus 10. I expect a little more from a growth company. Let's take a look at some earnings together. Excuse me, fundamentals. Let's see. Over the last 30 days, about 18%. Last 60 days, about 20% growth. Revenue is growing 67%. I like the balance sheet here. Tons of cash. Good income statement, good revenue. Cash flow is a little small, but looks like they're still growing, which is important. The key here is revenue, sales. Sales is the key. I don't have a PE ratio on this, but price to sales is 16 times, which isn't too much. Let's take a look at the valuation. Price to sales is relatively high versus the industry that they're in, 17% versus 11%. All this is on TD Ameritrade, guys. This can be free for you. Just open an account. Again, I get nothing. There's no links. You can just do this wherever you want. Doesn't matter. Price to book is relatively cheap versus the industry. And if, again, you don't know what price to book is, you can just click here. Price to book is the current stock price divided by the company's latest interim period book value, which is the net worth of the company divided by the number of shares outstanding in the most recent quarter. It varies widely by industry. So let's look at the peer comparison. Let's compare them to your peers. There is no peers, Twilio. So we usually have some, but we don't. If you believe in this company long term, dollar cost average it, put a little bit. Don't jump in with both feet. Let things roll. Again, buy shares as you go because it looks like to be a volatile one. It's down 5% post-market as of today, February 5th. So again, if you believe in the company, buy slices as you go and work that way. Next one, Manhu. I got into KHC, Kraft Heinz. They've been hammered pretty bad. I got in for dividends, but I'm losing my capital on it. Am I fine to keep this long-term frame? What's my take on it? Well, Kraft Heinz, you know who owns Kraft Heinz or did was Warren Buffett. And again, it's down 40%. I'm not a fan of it. Yes, the yield is high, but I'm not getting growth for my money. So there is that kind of seesaw effect. Remember, let's take a look at earnings. Let's look at some fundamentals together. Revenue's up 33%. That's fine, but Look at their balance sheet. Balance sheet is down. Not a lot of cash on the balance sheet. Income statement has been pretty okay. 3 years of consistent, pretty much flat on the income. Cash flow was down 2017, but they got it back. So again, if you want to pay a premium on this, let's see what the price to earnings is. They don't even have it, but the EPS growth, which is the earnings per share growth, is negative. For a large cap company, this is not a good sign. I don't care what they pay me. So again, I would probably cut that position and instead of looking at some other peer comparison, let's compare who else is out there that does the same stuff. We have Post Holdings, JM Smucker, Pilgrim's Pride, and Flower Foods. And you can see the 52-week change. Dividend yield, how about JPM Smucker? 21 times PE, again, lower than the S&P. Pretty much not as volatile, only a 52-week change of 0.33%. Solid dividend yield, and market cap of about $11 billion. So you can see their profit margins are a lot better than Kraft Heinz. And revenue growth is pretty much flat line, but again, it's a consumer staple company. Again, pretty much stays in your fridge, right? Jelly. So again, don't expect extreme growth, but I think this would be a safer play. So I would sell Kraft Heinz and go into JM Smucker if you want to stay in that sector. That'd probably be your best bet. Good question. Next one, Lena asks, Target versus Walmart, Target versus cost. I don't think we can differentiate on those guys. I think they're all great, those three. I think you want to own all three. If you prefer, this is a way to play all three. You can do the XRT, which is the retail ETF. Again, a big part of it is breaking down. We have Rite Aid, Michaels, Children's Place, Guess, Macy's, GameStop. These guys are part of it. So they do have some Costco in it. They do have some Walmart in it. They do have some Target into it. So you could always play XRT. They do have a dividend yield, but again, very volatile. But when it comes to Target, let's look at them. Target has a great PE ratio of 1774, good EPS growth, solid dividend yield of 2.33. Let's look at their peer comparison. Peers comparison, their peer is not really Walmart. It's more Dollar General, Dollar Tree. And they have a lower PE ratio than those guys. So I still rate them as a buy. They have a strong, solid profit margin. And you can see their PE ratio is lower, like I said. Revenue growth pretty solid. Earnings growth about 5%. And the revenue about $77 billion. So let's go ahead and see their 52-week change. They smoked the competition. Way above everyone else, 56% return on investment. Let's look at Walmart. Walmart and Amazon would probably be more, Walmart and Costco, I would say, are pretty much closer because Walmart owns Sam's Club. So let's look at their peer comparison. Again, Costco right here. 52-week change, 21 versus 44. Costco a little better. Obviously, they have their memberships. Dividend yield, Walmart pays a little more. PE ratio 22, so it's a little cheaper than Costco. So I do like Walmart. So again, it depends how much do you want to pay for growth. I like both. I can't say I don't like one or the other. Earnings growth is a little less on Walmart, but I think they turn around. Margins are a little better than a Costco. Revenue growth is a little less. So I would say, Lena, if I had to rank them, I would say Target, Costco, Walmart, but they're all good. They're not, none of them are bad per se. So that's how I would rank them. Next one. What are your thoughts on having a 401k? Great question. 401k, guys, is like having free money from your employer, as long as they match you. So again, you want to max that out. You want to get that free money. So 401k, if your company has a 401k and they match you dollar for dollar or percentage, you take that every single day. That's free money to invest. You take it. Absolutely. If you do not have a 401k at your company, you can open up an IRA with any bank and they'll go ahead and set you up and you can always invest in there. So individual, which is a traditional IRA, and you can always do a Roth. The traditional IRA lowers your taxes in the future because it's not tax deductible. But again, let's say if you make 100 grand a year and you put 10,000 in your IRA, you're only taxed on 90,000% of the income, not 100,000. So keep that in mind. It helps your deduction there. But if you have a Roth IRA, it uses after-tax money. So it grows, right? You can pull it out, the Roth IRA, whenever you want without tax penalty. But keep in mind, only on what you put in the principal, not the money returned, not the growth. So again, it is meant for long term. It's not meant as a piggy bank where you can just open back and forth. So if you do not have a 401k you should always do in your company if they match. If they do not, go ahead and go with a traditional IRA and then a Roth IRA. Roth IRA is not for everybody because it depends on your income bracket. Some people can't do it if you make so much above a certain bracket. I don't know exactly. But again, You can research that if you want to go ahead and Roth IRA. Let's just do Roth IRA here. Like you say, Roth IRA is an individual retirement account that offers you tax-free growth and tax-free withdrawals in retirement. I think, let's see, Roth IRA, here we go, tax rules. I think you have to make, there has to be something on here. This is, see, it's income bracket. Income limits, there you go. Go ahead and search that. So $6,000 you can put into a Roth IRA every year. You can put in limited on a traditional. And I know when it comes to Roth IRAs, you can only make so much. I'm trying to find that. Oh, income limit. So if you file taxes as a single person in 2018, I don't know if this is 2019, 122,000 or less, then you could do a Roth IRA. If you have more than that income, then you can't. So just keep that in mind. Okay, next one. Lena, again, I own Apple, Amazon, Microsoft for long. It's for my kids. But what do you think of a stock like Shop? Should I reevaluate stock? Is this a super long? That isn't a super long-term hold. If you're going to invest in a company like Shop, especially a volatile one, I would rather you do Shop long-term if you want to invest in it, because it's going to be a wild ride. Again, look at that growth, explosive growth. So I'd rather you just hold on to Shop long-term and see if you can get more gains out of it. I don't want you holding that thing for 1 to 2 years and then you can get a big drawdown of a 50 or 40%. I'll only say you can invest in Shop if you're going to hold it for 10 years. Same thing with like a Tesla. Again, 10 years or more for Shop. G.A.R I'm going to butcher the name, sorry. What do you think about NIO long-term? Let's say they obtain funding. Again, this kind of company is very aggressive, very speculative. Again, look at the 3-year drawdown, 40%. In 1 year, it's lost 50%. In 6 months, it has gained 50%. So it's outpaced the S&P. This is a difficult one because it is pure speculation. If you do want to get into NIO, you need to have a long-term horizon. Just like Tesla, just like a Shop, 10 years is you need to be your horizon. This is not a rental. You need to make sure you own this long-term if you want to get into it. Again, if you can handle that kind of risk, if I told you you can hold the stock, but you're might drop down 50% loss of your money, could you handle that? That's the question you need to ask yourself. Next one, Andres, that was great. Thank you. I have a very small position, still up after earnings. Dollar cost averaging makes so much sense now. You're very welcome. Trading agent, can you take a look at LSPD? They're like a mini Shopify. Okay, that's a new one. I never heard of that one. LSPD. Okay, I don't have anything called LSPD here. So maybe I put it incorrectly. Maybe you could type it again. Logan asks, you use trading profits to purchase stocks? What is your philosophy and purpose for trading? That's exactly what I do. On my profits, on my brokerage, I will go ahead and move it into 2 different funds. Muni, which is the municipal bond. Again, it's kind of like cash. I still get a nice yield, 2.37%. That's where I put my trading money. Again, it's a way just to keep cash and let it grow tax-free. So that's something I would keep into it and gives me an opportunity to withdraw if I need to. And I'd rather just hold it without a drawdown. So that's Muni. And the other one, again, is just simple S&P, SPYG, S&P 500 ETF. This is the growth one. It's about $44 a share. And look at the companies they have. Apple, Microsoft, Amazon, Facebook, Alphabet, Visa, MasterCard, Chase, Procter & Gamble. Can't go wrong with those companies. Again, SPYG or Muni. Those are the ones I would put my profits. But again, most of the time, I just trade my profits as I go along to grow the account. But if I ever want to move some money away, I put it in the SPYG or Muni. Good question. Lena asks, piggyback on Logan, what do you do with trading profits? Growing to your trading capital, cash on invest. At this very moment, I am just growing it. So I'm not really worried about cash because I have multiple flows of income from my other businesses. So I don't have to worry. My trading isn't my sole main purpose, my only flow of income. So I don't have to depend on it to eat, let's just say. I have other businesses that bring me money, which is my Amazon store, my other businesses, my other investments. So again, trading, again, it's a great flow of money, but I just reinvest it because it's more of an aggressive way to grow my money. I'm not looking at it for income. So I really don't save it as much. But when I do throw a couple of dollars on this slice away, Muni or SPYG. Thoughts on Nike? Nike, I do own it, and I do like it long term. The only thing with Nike, guys, is the valuation's a little high. PE ratio of 33 is above market multiple. EPS is pretty decent, but again, it has been growing even with China fears, and it's growing right with the S&P. And you could see there right at 20%, just like the S&P for about a year. And in 3 years, it actually has outpaced the S&P around 70%. So that's exactly some of the things I do like. Looking at the fundamentals, you could see EPS up about 11% for a mature company. That's pretty solid. Revenue is pretty weak at 7%. I would like to see it around double digits. Dividend growth about 13%. Look at the income up. Balance sheet is sliding a little bit, but tons of cash flow, which is a good thing. I'm a cash flow guy. I like Nike. I own some Nikes. Guys, when it comes to investing, invest in things that you know. Invest in things you like. Who's your cell phone company? Who's your car? Where do you pump gas? What shoes do you like? What kind of clothing do you like? What restaurants do you go to? Think of those kind of questions. Always invest in something that you know, guys. Don't invest in something that you don't understand, ever. That's the cardinal sin. Never invest in something you do not personally understand. Always. Next, Jordan asks, hey man, thanks for some solid gains in the past 2 days. Congratulations. Profiting up to today to pay the mortgage. Congratulations, Jordan. Thoughts on Verizon and T? I'm not against any of those. I own both, so I like both. I don't want to differentiate between both. The only difference is Verizon is more domestic, AT&T is more global. So kind of think of it that way. If you want more global growth or global mentality, then AT&T. If you want more domestic, United States, it'd be Verizon. Next one, what do you think about Diz? I own Diz, and I don't plan on selling it. Again, it's a place I love to go, Disney World. So Disney is, of course, an investment I'd love to own. You could see some of the fundamentals here. EPS about 8%. Revenue, I wish it was double digits. Dividend about 15%. Great balance sheet. Cash flow went a little bit down due to Disney Plus. Income is up, which is very key to me. Let's look at the summary in their EPS. PE ratio is lower than market volume, so it's not that expensive. Dividend yield about 1.22%. You're not going to get rich off that. And look at about a year growth. Disney is outpacing the S&P, and in 3 years, it is lagging the S&P about 10%. So look at it as you will. I do like Disney long term, and I'm a buyer of Disney. Love Disney. Yes, I agree. Next one. Is it okay if you can leave this stream on the channel so you can view it later? Yes, absolutely. This will be available whenever you need it on the channel. So make sure to subscribe, and you can watch this anytime. You can save this if you like on YouTube. We'd love to have you see it multiple times. It's really up to you if this helps. Are you completely against investing in real estate for the long term? No, Fahim, I am not against investing in real estate long term. I'm not. I'm actually looking to buy some real estate this year. So I love rental. I love cash flow properties. And I can't wait to buy my first one. Emmanuel asks, what about ESPO ETF? We're looking at esports gaming industry. Emmanuel, if it's something you're very interested in, I'd say by all means, invest in something that you actually truly like. It helps you track your investments a lot easier. If esports is something you like and you're a big video gamer, you know, Activision, Blizzard, EA Games, those kind of companies, look at this video games esports ETF. I don't personally own it, but I'm looking at some of the returns. Looks pretty solid. Tencent, Nvidia, AMD, Activision, Nintendo, Electronic Arts. I probably wouldn't be against buying a slice of this myself because, you know, I do like video gaming once in a while. So looking at performance longer term, again, I think it's only been created since 2019. So a growth of 10,000 go to 13,000 or more. So it's about, what, 40% returns since inception. That's pretty great returns in this bull market. So go ahead and get into that. I wouldn't be against it. I know that if you buy this ETF, Emmanuel, I know you're going to be more interested in it. It's going to keep you more engaged. It's going to keep you wanting to be involved in your investing, which is very key. Again, either one should be two things. Either be very involved researching or just buy it and leave it the hell alone and just don't touch it. Do not trade your investments. Just keep them. Do not trade your investments. It's not a trading account. Keep that in mind. 5 to 10 year horizon or more. Next one. Fahim says, would you recommend doing real estate and stock or strictly to stocks? That's really up to you. If you're the type of person that you only like stocks, that's okay. If you're the other person that only likes real estate, that's okay. Always invest in what you like. What do you prefer? Your preference. If you don't have any stocks and you just have real estate, that's okay too. Understandable. If you're the type of person that says, I hate real estate, I just want to invest stocks, that's okay too. Invest in things that you're going to keep engaged in. That's what's going to add success to you. So again, I like the mixture of both personally. I like to have multiple, so it doesn't really matter to me. You can have one or the other or both. Ready to help you with real estate? That's right, Dimitri in the house. Daniel asks, hey Carlos, always thankful for your help and time. Thoughts between JPM and C? Big difference, just like AT&T and Verizon. JPM is more domestic. Citigroup is more C, which is more global. So let's take a look at both. JPM is my preference for banks. Keep in mind, you're not going to get tremendous growth long term, even though it is outpacing the S&P, but it's very cheap on the PE, 12 times earnings, 2.66 dividend yield. They're returning a lot of cash. I prefer JPM over Citi. Let's look at the difference here, JPM and Citi. Citi is actually cheaper on the PE ratio, but it's underperforming the S&P in 3 years, but outperforming in 1 year. Dividend yield is slightly higher. EPS growth is slightly higher, I believe. So again, you can't go wrong with any. If I had to pick, gun to my head, I'm going to go JPM. What do you think about MMM, known as 3M, which is Jennifer Perez asking? Let's take a look at it. 3M is an industrial conglomerate. PE ratio about 20. Big drawdown within 1 year, 20%. 6 months is underperforming the S&P in a bull market. In 3 years has been a negative return. Good dividend yield, but again, I want to see some growth for my money for this stock. If I'm paying 20 times earnings, price to earnings ratio, and I'm getting this kind, I at least want to get at least single-digit growth, like a Coca-Cola or a PepsiCo. So 3M, I'm not loving it in regards to returns. Look at the fundamentals. Again, you're seeing barely single-digit revenue growth. Dividend is up, but that's about it. They're not returning a lot of equity back to you. So I would probably sell 3M and get into something else, like a Coca-Cola or a PepsiCo. Next one, thoughts on AGNC, Prospect Capital at Phoenix. I've never heard of anything like that, Gonzalo. I have to see AGNC. That's a new one. Oh, AGNC Investment Corp. Mortgage Real Estate Trust. Okay. Keep in mind, mortgage real estate investment trusts, they pay a high dividend yield. So you're not going to get a ton of growth. Understand that. They're returning equity back to you. If you really like it and you want to hold long term, I'll probably put that in the pile with Tesla. Same thing. Again, owning long term, I'm with it if you wanted that kind of yield. 10% it looks to be unsustainable, but mostly with REITs and investment trusts like that, you're going to get a high return because that's what they're meant for. By law, they have to return dividend and cash to you, the shareholder. I'm with TD Direct Investing and they charge $9.99 for every transaction. Do you think that'd be expensive to follow dollar cost averaging? Man, there's tons of other options out there that you get free trading. You can open a TD Ameritrade account. There is no charge for stock trading, meaning stock investing. You can do Robinhood, you can do E-Trade, you can do Schwab. They're all free. So understand that. You should not be paying $9.99 for stock investing ever. You're getting robbed, buddy. Lena says, thanks for your time. Carlos, very knowledgeable. G.A.R team rocks. Hey, thank you so much. We appreciate it. Appreciate that. One more thing, I guess since I think I've answered all the questions here for the most part. I had this conversation with a member of mine on the basic channel. We talked about cars. I know everyone loves cars, right? Everyone loves a car. You know, I see that a Lambo, everyone doing this on the Lambo or their nice car. Personally, I drive a Lexus. I do like my Lexus car. It's a lease, but again, it's part of the business. So I always tell people, how much do you love that car? How much do you love that car, right? That's the key. How much do you love that car? How much is your car worth? $600 a month? Let's break it down. $500 a month for a car payment where you can just buy a used car. Your car is holding you back, by the way. Keep that in mind. Your car payment is holding you back. Let's go and break it down. You went to the dealership, no trading, $5,000 down payment right off the rip, and your car payment is $500 a month. If you put that in the S&P 500 fund, I just told you 13% rate of return, 10-year growth. Guess what, guys? That $500 a month in 10 years is $144,000, and that's without investment of dividends. This is the assumption without dividends. So you can see the growth of your money. Start with $5,000, put in $500 a month. That means no car payment. You have $144,000 in 10 years. Again, S&P 500 funds. I'll even confirm it with you. How much do you love your car? In 10 years, you could have this amount of money, $144,000. It's very simple. Long-term investing. Just keep investing for the long term. Auto invest. Pretend that $500 doesn't exist. Again, 10 years, 13.4% market return. It's right there. So you have your car that you want to drive all the time, not including maintenance, not including gas, not including all that, mileage and depreciation. That $500 a month with that $5,000 payment, down payment, $144,000. Your car is holding you back from being wealthy. Keep that in mind. If I told you you can make in 10 years $500 a month that you deposit, $5,000 to start, $144,000. And again, there's no maintenance fee. There's no anybody telling you what to do. You just put in the S&P, $144,000 in 10 years. That's only if you do 500. That means that you just didn't even add anymore. You just said 500. That means forget any raises. You just said $500 a month. That's my car payment every single month. 13% return on an S&P 500 fund, starting with 5,000. The numbers are right there. By 2029, you've interest earns about 80,000 in interest. You added 60,000 yourself. Your starting amount was 5,000. Not bad at all. That's your car payment. And yeah, just wanted to leave it on that note. So again, think about it. How much do you love that car? Let's break it down for my exotic car fans, my exotic car people. Like, I want to own a Lambo. I want to impress people. Let's break it down. How much is it to buy a Mercedes S-Class? Down payment $8,000, and it'll be $1,000 a month. How much is it costing you to look cool? How much is it costing you to stunt and to be cool and to look rich instead of become rich? Forget looking rich. Become rich. $8,000 down payment, $1,000 a month. Yes, there's cars with S-Classes. Let's look at the math together. MBS USA. Let's look at Mercedes-Benz together, since we're together here, right? We're all friends. Again, if you like cars, I understand. I'm not here to attack you. So let's take a look at it. S-Class. Where is the S-Class? Vehicles. Sedans. And I do like the S-Class. So again, nothing against Mercedes. So let's see if we can find some deals. Shopping. New vehicle offers. Perfect. Excellent. New vehicle offers, special offers. Waiting for it to load. Let's look at S-Class because we like big cars. We really want to show people that we have money, right? We want to be rich. We want to look rich. Let's look at S-Class. And here we go. S-Class. Oh boy. Pretend you're leasing it. Even better because it's cheaper. The base model, the S450, lease payment of $949 a month. $949 a month. What was that down payment on that bad boy? $9,433. $9,343. Is that correct? Yes. Right. And that's for 36 months. Let's do that for 10 years. How much money are you going to make? Okay. Let's see. Make sure this is good. And let me refresh. I want to make sure this calculation is correct. And did I load? Load. Here we go. $9,343 down payment. $949 a month because you want an S-Class so damn bad, and you deserve it because you want to look rich. 10 years. S&P 500 fund. Hope you like the car because you would have made $273,000 in 10 years. Hell, with that money in 10 years, be a little patient. You could buy the car in cash if you wanted to, if you love the damn car so much. Think, guys. Think long term. Be rich. Forget looking rich. That's the key. That is the key to wealth. About to train the beds for a hoopty. Dimitri, no, you don't have to. You don't need a hoopty. Now, I'm not saying to only go coupon shopping. No, but be smart with your money. When you're rich, you can do rich people things. You can buy the S-Class in cash if you wanted to. That's fine. But doing this, imagine this. $9,000 for a car. $949 for a car. But what? If you have millions in the bank, by all means, do whatever you want. But we're talking here, you maybe don't have millions. $273,000 is a lot of money to a lot of people. That's a house right there in 10 years. So, Lena, yeah, man, where were you when I was 20 years old? That was like 7 years ago. Logan says, would you say that trading is the best way to accumulate wealth? No. Trading is, like I said, trading is speculation. Totally different ballgame. Investing is your key to wealth. Investing in discipline over time, 100% of the time, guaranteed will make money. You will always make money with discipline and investing with time. Those are the 3 pillars you need. The Tesla S-Lease is very tempting. Kevin, don't do it. Kevin, my VP, don't you dare. Save, buddy, save, and then you'll get there. I guess we'll end it there, guys. So I hope that last bit was fun for you. I enjoyed every part of this. Guys, if you love this channel, you love this video, please like, subscribe, share to others. More great things to come. Thank you so much for joining me this Wednesday evening. I know it's late for everybody, 8:50 at night, but you know what? I love to do it for you guys. G.A.R Capital, fx.com is the website. We appreciate you. Again, guys, you don't have to buy anything from us or become a client. We're just going to give you great content every time when we can on our channel. All we ask is for you to subscribe. Make sure to press that button. We really do appreciate it. Don't have to buy anything. You don't need to be a client of ours to enjoy our content. More great things to come. My name is Carlos Garcia, CEO of G.A.R Capital. I thank you so much for your time. Have a great rest of your night, and I wish you the best on your wealth building and investing for years to come. Have a great night, guys.